This window of opportunity to capitalize on this paper to physical gold disconnect will not last long.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
All right, welcome to Live from the Vault. As you can see, I'm out of the vault today in beautiful South Italy, and it is certainly a beautiful summer day right here. And this is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. Now, we have exclusive access to experts, insiders, and we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Morand, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver, these explosive markets, and we expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you the knowledge and the understanding that the mainstream media just will not provide. And with that, let's head over to the UK and talking gold with Andrew Maguire. Now, hey, Andrew from the south of Italy, it's hard to believe that we're halfway through 2023 already. And this would be a great time to look at how the gold and silver markets are faring as the paper to physical battle that we keep talking about week after week plays out into the Basel III environment. Can we start off today's episode with this update here?
Yeah, absolutely, Shane. And how nice to see you in the sunshine here. There is thunder, lightning, vertical rain. Glad to see you enjoying that lovely weather there, my friend. You deserve it. Good question, Shane. Absolutely. Let's start by looking at the very short-term footprints as we conclude the second quarter, and then really what to expect as this third quarter that we're in now progresses. Now, we're 6 months in to 2023 trading. So let's take a quick look under the covers at the major bullish gold and silver drivers following the game-changing Basel III NSFR regulations coming into force on the 1st of January. That simply means NSFR means that gold was morphed into a first-tier asset class. So let's step through just some of the Comex legacy market disruptor milestones we drew attention to during the first 6 months. Now, the open of 2023 trading marked the first moment in over 50 years that the 100-to-1 leveraged multi-trillion-dollar spot gold market became Basel III compliant. That is the moment it forced global liquidity providers and the LBMA market makers to back up their globally traded foreign exchange gold positions, whether they're long or short, with physical gold bullion. Now, that made a huge difference. Now, but while the 10 times larger spot gold market became T+2 deliverable, meaning that when it lands in London, it has to be delivered in 2 days, it's forcing the unwind of the legacy, and the LBMA acknowledges this and openly acknowledged that it was 100 ounces of paper gold to each physical ounce. And so we see the unwind of this legacy, really US-centric Comex futures markets. Really, while the London markets are compliant, the futures markets are not. So this is an interesting dynamic. And this is due to the siloed nature of the Comex futures markets, which actually forbid US traders from directly accessing the physically settled global spot gold foreign exchange markets, the ones that we can access, the one that the rest of the globe can access. Now, these siloed US traders seeking exposure to gold, and that could be an investment or a hedge position, could be any number of things. They're transacting long and short cash-settled gold paper warrants, not real gold, inside a globally non-compliant house-run Comex Gold Futures Exchange. However, under the resulting smoke and mirrors action, while still lagging global market Basel III compliance, ultimately, full Comex NSFR compliance is in motion, and for reasons we're going to explain, will be impossible to circumvent. Now, obviously, that creates opportunities. So, due to this massive leverage employed and the ability to corral literally all of the billions of dollars of daily siloed US trade into this rigged casino-like environment, this house-controlled environment has continued to provide a flywheel really, for the Comex paper to physical gold disconnect to continue. But under the radar, this fast closing price anomaly is presenting a once-in-a-lifetime opportunity to capitalize on grossly undervalued priced gold. So to put that into context, it's not unusual to evidence 10 million ounces of Comex gold two-way traded in a day. I mean, you talk about 19 billion of synthetic derivative gold. And this is why the Comex tail has to be able to, why it's still able to wag the physical dog and why it's been able to do it for so long. So obviously this process is under this deleveraging is underway. And as we identified, the Comex market pricing mechanism so really has not yet complied with Basel III. However, the opportunity window exposes the little known backdoor that we've been drawing so much attention to for the global markets to be able to convert deeply undervalued cash settled futures positions, or usually undeliverable futures positions, into the first tier asset categorized net stable funding compliant global delivery markets. So there's the back door. And while almost every CTA trader I have encountered in the US fails to understand or is forbidden from actually accessing this exchange for physical mechanism that we keep drawing our attention to, global central banks, sovereigns, and non-US traders are capitalizing on this opportunity to buy futures positions so they can exchange their rapidly depreciating, freshly printed dollars for physical bullion as it emerges from the legacy paper market diluted pricing mechanism.
Now, Andrew, with so much central bank appetite for gold since the start of 2023, I remember in our very first episode, you called this out on the first trading day of 2023. You know, this is all under the radar, of course, of the legacy paper market action. How is this impacting the physical wholesale markets?
Yeah, good question, mate. And to facilitate this gold-backed trade, what we've got is Russia, China, the BRICS Plus, the SCO, and an increasing number of African nations are openly adding published on-record gold purchases. This is stuff that is actually listed on the Bloombergs of this world, et cetera, et cetera. But also, additionally, they're adding much larger, unpublished, off-record monetary gold reserves to hedge and benchmark their respective currencies against what is really an overvalued, rapidly depreciating, debasing dollar. Now, while the PBOC has just officially logged its 8th consecutive month of official gold purchases in June, that was, and obviously now we'll see the July one coming up soon, that followed, if you remember, 100 tons of official PBOC gold buying executed just in the first 7 trading days of 2023. Now, these official purchases pale in relation to the unofficial monetary gold purchases, which absolutely do not need to be reported. Also, interestingly, the Financial Times, which is no friend of gold, this week confirmed that a growing number of central banks are bringing their physical gold reserves back home to avoid a Russian-style sanctions on their foreign assets. And this is the FT. So while really, and what they're saying is while they're increasing their purchases of the precious metals, in their words, as a hedge against high levels of inflation, it also confirms these purchases are in physical form. Also noting that the exchange, the ETFs, the exchange traded fund holdings, are being redeemed. We'll look at that in a minute. But it's clear what is clear is that official reported central bank gold demand, when it's finally officially reported, is going to exceed all of 2022's reported over 50 years record physical demand levels by at least a factor of 2 to 3 times, while off-grid, unreported third-party demand feeding this trade will at the margin be responsible for forcing the unwind of leverage to drive the gold price substantially higher. And it's important to understand that as influential as they have been in pushing back against the rising gold price, the LBMA CME alliance, which was formed back in 2020 when we had that massive EFP blow up, the cartel, as we call it, has no control of off-grid demand. And while they focus on ring-fencing the billions of dollars of corralled US-centric flow inside this Comex exchange, it results in actually fixing the related net stable funding compliant gold fix benchmarks in London far too low to match real plain vanilla supply and demand fundamentals. Now, whatever happens, whatever we fix that in London is actually deliverable. Now, this results in an increasingly larger, arbitrable physical gold outflows, which ultimately expand the Comex leverage to increasingly nosebleed levels, with an increasing number of central banks really refusing to buy counterparty risk non-compliant ETF gold, while, as the FT admits, converting these derivative gold positions into bullions. So it's draining the Comex open interest, the Comex chips, casino chips, as we call them. So these synthetic price containment efforts will increasingly backfire as we progress through 2023. And this is why every first-tier bullion bank is buying physical gold for their own accounts. So what is not immediately apparent outside this siloed Comex bubble, which only continues to exist because the Fed has locked US gold and silver traders inside it, every single global central bank, without exception, is openly, on record and otherwise, purchasing physical bullion in unprecedented size, capitalizing on this synthetic legacy price. And there's nothing to stop, though, US citizens buying physical bullion at these discounted prices, which is something we're beginning to see more and more and more of. Now, but as we warned in our last episode, this window of opportunity to capitalize on this paper to physical gold disconnect will not last long. Alongside this global race to alchemize synthetic gold into real bullion, unlike the Fed, Comex ringmasters, let's not forget that by the commencement of 2023 trading, the Bank of International Settlements, which is the Western Hemisphere central bank of all central banks, had led the way on record repatriating, i.e. buying back every single ounce of the 50 years of accrued derivative gold bets. They would leverage gold bets. So what they did was square the last over 500 tons up against the synthetic cash settled Comex bubble, just ahead of gold being revalued as a first-year asset in January. Now, any fresh swaps that have been added since then sit on the Fed's account with them. So no, don't be fooled by the small amounts that were being shown as swaps were actually Fed owned. But the Fed, I'll reiterate, the only central bank still exposed to 50 years of accrued, rehypothecated, undeliverable, derivative gold bets, has been caught extremely wrong-footed by this, unable to exit thousands of tons of underwater derivative exposure. And this massive miscalculation has created a huge opportunity window for us all to secure cheap bullion before the Fed is forced to fold its hand, which ultimately it has to do. And this is why we've been drawing attention to the Comex Achilles heel, which outside of professional circles is little known, which is this little known EFP conduit that we talk about, the mechanism that allows the conversion of otherwise cash settled paper gold futures market derivative bets into real bullion as settled in the NSFR compliant globally recognized spot delivery markets. Now, obtaining bullion this way really cuts delivery transportation costs and flies under the radar until it's executed. Now, following Basel III gold market compliance, now the Comex EFP backdoor began providing friendly and unfriendly global central banks an alternative window to lock in paper prices and utilize this EFP mechanism to force delivery of these Comex derivative gold prices into the compliant spot gold market, where these paper bets become, as I say, deliverable. It's so important to understand this. And these physical outflows escape the cartel's managed ring fence. And due to the unwinding of related paper market leverage, it's notably draining lifeblood liquidity from the only remaining non-compliant global gold exchange. This window is actually contracting. Many US traders are completely blinkered to this. They cannot see the wood for the trees. Well, clearly, because you're not allowed to trade outside of these. And perhaps those that are not that don't ever look to physical, obviously wouldn't know that the wholesale market is diverging from this. So obviously, I'm not talking about our subscribers here, clearly. Now, when gold exits this containment ring fence, what it does is eliminate the cartel's ability to borrow and lease out this bullion. Obviously, it's financed by officials who have unlimited freshly printed fiat supply, which obviously serves to hide the true supply demand data. But what it does is expose these ETF outflows.
Yeah, this is huge, Andrew. I know that you had mentioned that these gold ETF, the exchange traded funds, were being affected. And I know we get a lot of questions about the ETFs. Can you elaborate on these ETFs?
Yeah, Shane, this is really interesting. As while this EFP conduit is backfiring against the house, it is also impacting the connected ETFs. Now, it's important to understand that this EFP facility was originally set up just to be able to spin paper gold into the ETFs so as to be able to square these long Comex positions one-to-one against the gold, the GLD ETF. Now, considering that the GLD ETF is deemed to be by the ringmasters as equal to physical gold, it allows for unbacked leveraged Comex positions to erroneously being counted as physically delivered, which clearly it is not. Now, the GLD ETF enables US-centric traders, which is largely hedge funds with no mandate to take physical delivery, and CTAs looking to gain exposure to gold, enables them to convert long leveraged gold positions into shares of the trust. Now, given both sides of these transactions are leveraged, global supply demand is not necessarily influenced. Now, the belief that by purchasing GLD shares results in physical bullion being purchased and one-to-one deposited in the trust is a complete illusion. In fact, we produced a very short video on this ETF illusion. I'm going to ask the team to put up a link on this because it really sums it up really quite well. Now, given the on and off ramps into the ETFs are facilitated in unallocated gold form, held on the books of the same Comex market making actors who would be on the balancing short side of these long Comex buyers, in other words, making the market, and that these ETF shares can subsequently then be shorted, double owned, has presented a historic price capping flywheel for the house to dilute real supply demand fundamentals. However, since the 1st of January, spot gold had to be physically backed, and given that the ETF on and off ramps momentarily transit through the NSFR compliant spot gold market, it potentially exposes these GLD shares to be turned upon for delivery. So unless these ETF redemptions are tied to the Comex related client who can't take delivery, it poses a risk to the illusionary ETF, which is significant because this is recognized as the largest store of above ground Western held bullion, and it risks being raided for bullion into tightening supply at paper-induced prices. So, I mean, so far, the whole suite of derivative gold unwind has been orderly, but as the FT illustrates, central banks are ditching derivative exposure and want the real thing. So as global tensions increase, the ETF illusion is at risk of being exposed. And when it does, watch out. Now, when looking at the ETF from a risk reward perspective, you just simply have to ask the question, yes or no, is the ETF one-to-one backed by bullion, or is there counterparty risk? That's the only question to actually distills. Don't bother reading the whole lot, yes or no. And we have been drawing attention to the risks of any one of several black swan events that could drive the gold derivative market bid only. And take a pick. There's so many. And such an event would be the likely trigger for global central banks to consider revaluing their gold assets to market. So for a central bank to tap into their gold revaluation accounts, which they all have, it's simply a matter of selling the GRA gold at the at whatever it's held at on the account value, which is well below market price, and immediately then buying back the same amount of gold at market for a realized gain. So obviously that would create anybody who's got physical gold will actually be able to protect themselves, but they will want a higher gold price. And as soon as one central bank monetizes its GRA facility, they'll all have to do it. However, when global central banks do revalue gold, it also exposes the GLD unallocated spot gold off-ramp into NSFR compliant spot gold delivery markets, forcing T+2 physical delivery, upsetting the plan to square these redeemed shares back into the cash-settled Comex exchange.
Now, Andrew, given it just seems that the Fed is really out of touch with actual gold as an asset class. And when gold is revalued, we've been talking about this for a while, when it's revalued against the dollar, where does that leave them?
Yeah, I've had a ton of questions on this, Shane. Look, the Fed's hair trigger to revalue gold will be when they are forced to follow a race by other central banks moving in sync really to utilize their gold revaluation accounts, their GRA reserves, basically. It would be absolutely implausible for the Treasury to continue to value their 8,133 tons of gold at $42 an ounce, when the global race to revalue may easily overnight gap the price of gold well into the mid-2000s, and that's just the first gap. Look, with price assessments in focus, let's put this question actually into historical perspective. Now, the current ratio of gold to foreign debts outstanding is well under 6%. In fact, is much closer to 4%, but even accepting the unadjusted higher 6% level, this ratio is significantly below the 20 to 40% historical average, which the BIS, the Bank of International Settlements, likely expects this ratio to ultimately revert to following the full implementation of Basel III. Now, restoring a 20 to 40% ratio of gold to foreign debts outstanding easily puts gold around 6,000 to 12,000 per ounce, depending on that ratio. However, the last time the US dollar was questioned was in 1980, when the foreign held treasuries of the US government were 140% collateralized by gold. And so at 1980 levels, that would have put gold at over 40,000 bucks. Look, I'm just saying, it clearly would be preferable to revalue treasury gold to market. But either way, the true supply-demand price would be evident. And once the Fed capitulates, it'll benefit the Fed to seek a stronger gold price, which is the inverse of what they are doing now. So anticipating your question, Shane, yes, where does that put silver? I could hear you saying it. The gold silver cross is currently around 83 to 1. Ludicrous, 83 to 1. And with gold being revalued and silver's joined at the hip, it would not only would it contract the ratio very quickly, but likely immediately. I mean, we'd probably see 36 to 1, ultimately on its way to 16 to 1 or even less. But even at 50 to 1, it puts silver at a minimum between 120 and $240 an ounce.
Wow. Andrew, I know on the last episode, we revisited the empirical evidence that the Fed has a serious rehypothecation issue regarding the 8,000 tons of treasury gold it manages. Now, will this prove to be a problem for the Fed moving forward?
Yeah, Shane, treasury gold rehypothecation is a separate issue. And as long as the Fed was in sync with all the other global central banks in revaluing gold, the extent of this 8,133 tons of double ownership would not be exposed. That is, as long as it ain't caught out by all these recent repatriation requests. We all know what happened the last time that happened, and Germany tried to get 300 tons back. It was going to take 7 years. Ludicrous. And so, look, but with US traders unable to access the NSFR compliant physical markets, guess who's going to be on the long side when they halt futures trading? And as we outlined last time, we don't see the Comex defaulting, but any shorts, even short hedge positions not backed one-to-one by physical bullion, will receive a religious experience.
All right, Andrew, thanks for that. Now, you mentioned some other milestones earlier. Can you share with us what some of these are? Just before we get in, I know you talked about silver. I was going to jump on that, but then we maybe can move to silver.
Yeah, we will do. We wouldn't leave this episode without talking about silver, Shane. So look, now reviewing the wholesale market structure following this 6 months that gold has been valued as a first-year asset class, we see gold has only just begun to be more widely accepted as an alternate first-year asset class by some of these siloed US-centric traders. Now, the split in the Comex speculator category is the next milestone that disrupts the legacy game. They need every single ounce of open interest to game. And if you can't rinse it easily, that's a problem. And it's important to understand that with Comex paper gold now being recognized by this expanding group of Comex speculators as a first-year asset class, it's created a growing split in how the historically easily gamed speculator group is how they're unraveling this 95% win-lose house odds, which is the casino odds. And as some speculators are employing gold as a component of their suite of risk hedging tools, this group of speculators will not easily be rinsed of their paper gold positions on a rig price decline. It still worries me that if they're not backed one-to-one by physical, if they're using this gold position to hedge some other risk asset. But gold hedges alongside cash and bonds really are beginning to act as the fire insurance they were purchased for. And another milestone, to answer your question, Shane, was uncovered when Russia surprised the market at the open of the year, when Sberbank, in collaboration with the Russian central bank, announced they'd digitized the first tranche of Russian central bank physical gold and placed it on the blockchain, the trustless blockchain, Stellar. And as we noted in our first 2023 episode, this was the thin edge of a financial wedge, telegraphing that a physically backed gold benchmark non-dollar currency was being trialed to price commodities valued in gold grams. Now, while completely ignored by the mainstream media, what this action reaffirmed was that Russia had stealthily begun to implement Sergei Glasnev's golden ruble 3 currency, ultimately is going to be the death knell for the US dollar and its globalist objectives. So we need to put this into perspective. By sanctioning the digitization of central bank physical gold placed on the trustless blockchain, Russia began the process of cutting out the fiat middleman, opening up physical gold to serve as a medium of exchange, a unit of account, a store of value. Hey, what does that sound like? It sounds like a currency to me. And obviously, they're using that to benchmark this new trade settlement currency. Now, 6 months in, and having built the infrastructure and consolidated its interconnected gold alliance with China, over 80% of Russia's trade is now conducted in rubles and yuan. And following the recent SCO summit in India, the next more formalized leg to open up gold and the yuan gold-backed commodity settlement trade is upcoming next month at the August 22nd to 24th BRICS Summit in South Africa. Now, the BRICS Summit will pave the way for a BRICS SCO trade settlement currency tied to gold. And while the currency basket will comprise of a lot of components, physical gold is the linchpin of the currency bond market.
The BRICS group is set to introduce a new currency backed by gold, in contrast to the credit-backed US dollar, with countries lining up to join the growing initiative.
The BRICS countries are planning to introduce a new trading currency which will be backed by gold. More and more countries recently expressed desire to join BRICS.
The decision comes a month ahead of scheduled Alliance Summit in Johannesburg, South Africa. 41 countries have since shown their interest in BRICS membership and its new currency implementation. Russia's foreign ministry has stated that if African states show enthusiasm, the group's expansion may also be on a Russia-Africa summit's agenda in the end of July. As of now, the BRICS group remains comprised of Brazil, Russia, India, China and South Africa. Former Statistician General of South Africa, Pali Lehola, says the gold-backed currency will facilitate the advancement of developing countries.
Avoiding using the gold standard, we have gone for almost 45 years now, since 1980 when this was dropped. And we have seen the consequences, particularly of this to the developing countries, when the dollar was adopted as a standard and gold not as such. Yet against that, there's been accumulation of gold in the developing world. South Africa had a much stronger currency when the gold standard was still in force. By going the gold standard by many countries, that many African countries, of course, have, this will be of great benefit to strengthening the currency, the single currency that is backed by gold. It will facilitate development. Because after all, currency is the quantity of material things that societies have. If you use another currency based on material wealth or material things you don't have, it means that you are at the mercy of that country, and and they will charge commissions and the like.
This unwind of paper market leverage has far-reaching effects. And as an example, you'll recall we had highlighted one of the long-standing cartel house-run manipulation levers, the trade at settlement sledgehammer that we call. We actually looked in granular detail at that in a May episode. And this gold settlement currently is actually one of the interesting things. It's going to provide discipline on the house into this current TAS positioning. So look, let me explain, and I'll keep it quick and to the point. So far this month, just July, and we're only on the 12th today, we've evidenced the swap dealer commercial trade, largely comprising of the agent cartel members, had already swapped out a notional 163 tons of gold futures contracts between the August and the December contracts. So Shane, if you remember, in our efforts to demystify how a rigged market operates, we went into this granular detail, and it was in a May episode. I can't remember which one it was, but definitely one of them. And how this TAS manipulation lever works. Look, if anyone wants more information, please go back to that episode. But to sum up, really, while this particular house game is risk-free because it's price risk hedged, and on the face of it, legitimately capitalizes on time value by simultaneously buying a front-month futures contract at a cheaper price while selling short a further out contract, perfectly legal, as if they're executed simultaneously, but by scheming to disruptively close the long side of the hedge first, while deliberately keeping the short leg open, they turned this so-called spread trade into an illegal practice right under the nose of the regulators. And we evidenced a perfect example of this activity 2 days ago on Monday. And it was no coincidence that this extremely counterintuitive Monday, post-Monday non-farm payroll chart painted downside gap. In other words, we saw everyone piling in after non-farm payrolls was a beat. And what do? They come in, bid pull, and close that gap almost as if nothing had happened. But they used that to execute their trades. So what they did was they triggered this by selling short 10,377 lots of December futures contracts to trigger a spec long capitulation. In other words, rinse out all the guys that came in, then to hide the intraday position limit violations, and they were violated, they bought an offsetting 11,080 contracts of the August contract at the rigged lows. So first of all, the December contract was sold, created an air pocket, then they cover their footprints by buying the August position. Now, this predatory swap dealers, they locked it. What they've done is lock in and will, by close of business on November the 30th, legally bank the plain vanilla spread of about $38.60 an ounce, but have gained more by rigging the price legs to their advantage, as we saw on Monday. And look, this trade's nothing illegal about this trade. We have executed this trade ourselves, but not in the kind of way that they do that. However, at the point I'm trying to make is that this game is not only becoming far too well known with these market making insiders instigating these deliberate air pockets, but then now encountering unwanted friction as competing central banks and sovereigns looking for opportunities to capitalize on this resulting Comex leverage EFP backdoor move to convert these Comex positions into deliverable contracts in London, ultimately forces an overall unwind of heavily leveraged Comex open interest. You cannot deny that that's happening, and it will become more evident. And the friction has become much more evident since the 1st of January, forced these EFP Comex gold trading in London to be delivered. And this is what Gatter described. This is the Gatter-like enveloping horn that is beginning to force discipline on insiders, creating these air pockets. Gatter talked about this years ago, decades ago, and I would really encourage those that haven't done that before to visit the Gatter website, just to understand how that works and how that will ultimately play out. Now, the clues are all there, here and now. Having spent 6 months quietly incorporating digitized physical gold into their Sino-Russia-India commodity trade, Russia stepped up the ante last week, announcing the formal launch of a competing live physically backed ruble-denominated gold futures exchange that will provide the BRICS SCO trade a physically backed alternative to the highly leveraged Comex US dollar cash settled exchange. Now, more immediately and directly related to facilitate this upcoming trade, we've evidenced Russia offering a lockstep, physically backed competing spot bid, and that's currently a consistent $1 to $4 premium above benchmarked NSFR compliant spot gold in London. And that's expanded to as high as $14 when we saw the algorithmic gaming into the non-farm payrolls dip. And we're also seeing concurrently, separately, a $10 to $20 premium over the gold futures contract in the separately freshly launched Moscow futures contract. And that's currently right now at a $17.38 premium to where the Comex futures are. And that's despite spiking higher after CPI. Now, aside from a noted large increase in Indian gold smuggling since the beginning of the year, that's far in excess of what the World Gold Council estimates of 30 tons a month, this alternate Russian physically backed spot gold exchange is facilitating right now large Indian flows to start to bypass London, largely through Dubai and other physical exchanges, all benchmarked to the 2 London PM fixes. Now, given the consistent spot premium offered by Russia, this lack of Asian market flow through the rigged LBMA London fixes is misinterpreted as a lack of interest in gold, whereas these flows are and will increasingly be facilitated through other channels as they evolve. First-year market-making banks will be aware of this, whereas the Fed is the only central bank still short gold. They're once again blindsided. This is unbelievable. Yes, we spoke to Daniela DiMartino Booth, an ex-Fed insider, who says they just don't understand it. Well, clearly, and obviously they employ they employ agents to control the price of gold because it competes against the dollar, but they don't understand gold. And having looked at this before, we've looked at this. But given the BRICS Plus and applying members control the lion's share of commodity trade, when assessing if there's sufficient liquidity to drive the adoption of tokenized gold, there's only one only has to look at the aggregated size of these sectors and who controls the lion's share of supply and consumption of these globally consumed commodities. And these hard commodities are largely in the control of Russia, China, the BRICS SCO members, including Saudi Arabia, along with the deemed friendly countries. Now, to provide an idea of the potential scale of this global market, the global oil and gas market is worth 7,000 billion per annum. I'm putting that in billions. Add in the 5,000 billion per annum of commodity and energy sectors, then you've got to see the estimate of the de-dollarization potential becomes much, much clearer. And adopting gold as a benchmark to create a basket of gold-backed currencies will enable a diversification of reserve holdings, allowing these largely exporting emerging markets in many instances to gradually opt out of the increasingly weaponized SWIFT payment system. An alternative gold-backed currency becomes the only sustainable currency to benchmark a commodity price to facilitate the non-dollar trades between nations. And as the gold for the commodity benchmark eats into the unipolar dollar-centric price commodity market, it will accordingly raise the price of dollar-denominated gold. It has to. And we're in close contact with our well-connected first-tier liquidity providers, our Russian refinery contacts, to better assess how this will translate into a real physical demand, supply-demand price, and on what timescale. But what is clear is that the inherent Western cartel paper gold derivative game is ultimately going to explode. Nobody wants or expects the dollar to immediately collapse. No one wants it or expects it to. Clearly, there's a lot of vested interest that it cannot be unwound in a hurry. But as this process evolves, derivative gold will be discarded and real physical gold price will emerge. And since Russia started tokenizing physical gold to provide a tradable alternative to benchmark the non-dollar denominated commodity price, at the margin, this drain of physical gold is structurally impacting the imbalanced, ring-fenced, asymmetric, long over-the-counter short futures envelope, which has been the traditional game. This will become more apparent as physically deliverable foreign exchange gold dislocates from the dollar strength or weakness. And this is an opportunity for stackers to accrue more bullion for less dollars, pounds, euros, etc. So what we're doing is currently witnessing a major inflection point in how gold measured in all fiat currencies is priced. So what we're saying is we're privileged to be at a point where we're living through what the history books will look back at as an event where the weaponization of physical gold took a whole new turn, opening up a highly liquid non-dollar mechanism for the BRICS, SCO, and ultimately the Eurasia Economic Union, the EAEU, to facilitate trade outside the unipolar legacy system, benchmarking commodity, energy, and oil trade to this real physical supply demand gold gram price. Now, market disruptions will be really far reaching. Now, as an example, currently an ounce of gold buys 24 barrels of oil. As oil is de-dollarized, an ounce of gold will easily buy double that, if not more. Now, conversely, in dollar terms, this is important, it would be massively inflationary for dollar-priced oil. Now, very short term, the very large central bank-related spot orders sitting at 1900 are still there. We talked about them last time. We said anything below that level ain't just not going to last. In fact, if it isn't hit again, and we've just had CPI, if it's not hit again, well, then they're going to raise that up higher. But it's not sustainable to have that a price below 1900. So any dip would be short-lived, and sure was. So CPI, as you say, was just released. It was a miss, but while the algos react to the upside, as we see now, as long as the stock market rallies, Powell will have the cover. He'll have the cover to keep hiking. However, following JP Morgan's warnings of the fragility of the commercial real estate sector last week, the subsequent hawkish spin and concurrent news beats, raising the odds of at least another 50 basis points of hikes yet to follow for the rest of the year, what that has is risks reigniting the banking contagion. And last Thursday, we saw 6-month office mortgage delinquency rates experiencing their biggest spike ever recorded. This is a risk that is growing, and it's certainly going to have the attention of the Fed, and it may constrain what they do. And as these largely ignored contagion risks come into the forefront, stocks will actually risk a large sell-off, which would halt the Fed's ability to hike, providing the impetus for the next bullish paper gold driver as we head further into the third quarter. There's so much that's going to happen. And as far as the wholesale physical market is concerned, which is where our view is, under the paper market generated volatility, central bank demand for physical gold continues to be reported as very strong, tightening supply, and this will limit how far the bid-pulling cartel can push the downside envelope, with gold now coiling in oversold conditions.
Now, Andrew, it seems like Russia and the BRICS, every time you talk about Russia and what they're kind of signaling and BRICS, it seems to me like they're modeling the Kinesis monetary system. I know, just a comment there. Every time you talk about it, that's all I could think of. But earlier you mentioned 83 to 1. I can't wait to ask you, for all of our silver community out there, 83 to 1. What are you seeing in the silver market?
Crazy stuff, Shane. Absolutely ludicrous. The unallocated on and off ramp authorized participant gatekeepers in SLV, which is the other illusionary exchange, the ETF depository that we've talked about in gold, and of course we've looked at this in the past in other episodes. Don't forget, these can be double owned too. And what this has done is we've evidenced these predatory banks started to cut their bets against silver. Silver supply is an increasing deficit and consistently being jumped on by Asian Chinese buyers into the blinkered spec-held current synthetic deep discount. This is what we're seeing here. This is a synthetic discount. Also, given the underwater option structure, it also indicates the commencement of a spec short squeeze, which insiders are going to be on the long side of this. So as we noted just 2 weeks ago, Shane, silver is the most oversold since it bottomed out under $20 back in March 2020. And given the supply deficit and very strong Indian demand, it looks really attractive as a buy with very limited downside. So this is where we end up, Shane. There is only one question. How much physical gold and silver do you own, guys?
All right. Thank you, Andrew Maguire, for talking gold. Another fascinating episode for sure here. Now, remember, to our Live from the Vault community, buy physical, make sure it's backed 1-to-1, and understand the difference. We talk about this all the time between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Now keep spreading the word about this channel by hitting that like button, share this information, and make sure you subscribed if you haven't already done so. Now, if you click the bell right there, you'll be notified in real time every time one of these episodes goes live. So with that, we'll see you next time right here on Live from the Vault. See you then.